Hello my fellow investors and welcome back to another stock analysis video. Today guys, we're going to be reanalyzing the company Hewlett-Packard, which by the way is actually the company HP, yes, the one that sells laptops. And I actually have done this one before back in February. However guys, I have changed the calculator up a lot, and also man, if you hear that one, it just sounds awful. Oh my god, I cannot understand how you guys saw that one with that awful mic. So we're going to be analyzing this one again, seeing that the earnings are also guys after close on Tuesday. So I figured, let's analyze it. Let's see what has changed, maybe with the new stuff that we have added with the calculator. Maybe we like it more, maybe we like it less. I don't necessarily know. So with that said, let's get started with this analysis. Before we actually get started with the dividends guys, well, let's actually start off with their earnings, because they had earnings on May 31st of this year. And you can see right here that their EPS normalized actual came in at a beat by 3 cents. However, their EPS gap actual came in at a miss by 8 cents. Their revenue, on the other hand, came in at a beat by $305.04 million. And on top of that, guys, let me show you something very quick. I mean, you guys are seeing it right here, but looking at the share price, guys, today on Sunday, as I'm recording this, on Friday, guys, the market fell, and you can pretty much see it right here, right? It was just like boom, just absolute crash because the Fed came out talking and the market crashed. That's actually a good thing, believe it or not. It really is a good thing. So yeah guys, on Friday you can see that even before 4 p.m. it fell 9%. Yikes. And after market it fell another 0.5%. So in total it fell around like 9.5%. That is actually amazing. Like, that's really surprising. So let's see if at this share price, which I believe last time I did it, it was like at around like $40 or so. I'm not fully remembering, but it was definitely higher than this. So let's see now what we would actually pay for seeing all of these earnings as well as the current share price falling. So let's head over now to the dividends, starting of course with the dividend summary guys. Look at this. This is what I'm talking about, that when markets fall, it is a benefit for everybody, right? It is a benefit for everybody, especially if you are a long-term value investor. Look at this dividend yield, guys, 3.2%. That is insane. That is absolutely insane. And you're probably thinking about this like, oh, you know, that's fairly good. Guys, the market right now, I believe the S&P is less than 2%, I believe. So right then and there, you're getting a massive yield. Now, this comes out to be 25 cents per share for an annual payout of $1. Payout ratio, guys, is 21.54%. So that's really good, right? I mean, to be fair, this isn't into the cash flow. We're going to take a look at that in just 1 second. But 21.54%, it is a really good starting point. And the goodness just continues. The 5-year CAGR, guys, is 12.5%, essentially 12.6. Within the past 5 years, they have increased this dividend at around 12.6%, which is amazing. And on top of that, they have grown this dividend for 11 consecutive years. Not an aristocrat, but still fairly notable. Ex-dividend date, guys, is actually coming up on the 13th of September. So, you know, let's analyze this company. If you guys like it, by all means, then, you know, you should buy it. You're going to get in before the ex-dividend date. You will get paid on October 5th. Which is fairly good. It's actually a company that pays out on the off months of January, April, July, and October. So all in all, it actually might not be a bad company to buy. And of course, they do pay their dividends quarterly. Let us now come, guys, into the calculator. We got the ticker symbol of HPQ. Make sure you do not put HP, because that's a separate company by itself. HPQ, market cap of $32.5 billion. The PE, guys, of 5.63. That is actually really good. So again, with the current share price of $31.39, we might actually consider buying this, guys. We really might. Annual dividends per share, as we saw, is $1. And in accordance to their shares outstanding, guys, they pay out every single year, look at this, $1 billion. In accordance to the 5-year average free cash flow, they're still left with, look at this, $3 billion. And in accordance to the last year's free cash flow, it is $4.8 billion. These payout ratios come out to be 17.73% for the last year's free cash flow and 24.84% for the 5-year average. So all in all, guys, when it comes to this dividend, not only can they continue to grow it at that 12.6%, but they are able to even pay it off in the first place, which is really good. Now let us jump into the fundamentals, starting of course with the net income, guys. We got 5 years ago of 2.5 billion to 1 year ago of 6.5 billion, increase of 157%. And it's unfortunate because this graph doesn't look too good. From 5 to 4 years ago, they did increase, but then they fell from 4 to 3, and then they fell again from 3 to 4, which is again surprising because 2 years ago, guys, COVID was happening. You would think that a company like this, like a tech company, would be doing fairly good, but it didn't. It actually fell. And then as of last year, they did go up to $6.5 billion. So it's good in the sense that there are no negatives. Okay, that's great, but it's not consistently increasing. So I'm going to have to give it a fairly low score of around like 45% or so. Coming down to the free cash flow, the most important of all the profit metrics, because this is the one that companies use to pay out that dividend. And if you guys like that dividend, you want this thing to, of course, continue to be increasing and, of course, just be positive in general. They can also take their free cash flow, guys, to pay down their debts, buy back shares, make acquisitions, and overall grow the company. So this is why it's the most important out of all the profit metrics. We got 5 years ago of $3.3 billion to 1 year ago of $5.8 billion. That is a 78% increase on the 5-year, with a 5-year average of $4.16 billion. Now, this graph looks a lot better than that of the net income. Don't get me wrong, but unfortunately, it still doesn't meet the 2 criteria that I like. And that is the one that it's at least remaining positive. And the second one is that I like it to be consistently increasing, and unfortunately it is not. So from 5 to 4 years ago, it did increase. From 4 to 3 years ago, it increased, but it only increased, guys, by $1 million. It's actually hilarious. It went from 3.982 billion to 3.983 billion the following year. And then during COVID, guys, this did fall to 3.7 billion. But then as of last year, guys, look at that. They made it all up to $5.8 billion. So I'm not going to give it a low grade like this one. I'm actually going to give it a little bit higher just because, okay, COVID related number, and they did go up over here. It's technically an increase. I get that. So I'm actually going to give it, guys, essentially like an 80%. It's not the best, but it's good enough, I guess you could say. And now looking at the revenue, we got 5 years ago of $52 billion to 1 year ago of $63.5 billion, increase of almost 22%. And well, it's actually fairly interesting because this one's really, really close to that of the free cash flow one, right? 5 years ago to 4 to 3, it increased. And we can see over here as well that from 4 years ago to 3 years ago, the increase was very, very tiny. This increase was around $300 million. And from 3 years ago to 2 years ago, it did go down, but 1 year ago, it did go up again to $63.5 billion. So, you know what? Okay, I'm actually going to reassess these. I'm gonna give this one, guys, essentially an 85%. I do like it. Don't get me wrong, I do like it. But let me actually come back to this one a little bit again. Because if this is a COVID-related thing, which I know it is, right? It obviously is. I'm actually going to give this a little bit of a higher grade just because, from here to here, I have to essentially ignore this one, but I can't ignore this one. So for that reason, I'm actually going to bump this up to around a 60% when it comes to their net income, just because of the fact that this one's understandable, this one isn't. So I'm going to give it a 60% when it comes to the net income. Now let's actually come over here to the total assets minus the total liabilities. Let's actually analyze this, guys, because, well, last time I checked, this wasn't too good. And I believe, guys, last time we did this, I did not use total assets and total liabilities. I used total current assets and total current liabilities. So the numbers on this will obviously look different from that video in the past. So I think these ones are a lot better. Now, the reason why we analyze this is because total assets minus the total liabilities pretty much just shows us if the company's assets cover their liabilities, right? It's pretty obvious as to what it stands for. And of course, you want this value to be in the positive and of course, increasing as well. Now, when it comes to this, well, this isn't too good, guys. Currently, they're at almost a negative $2 billion when it comes to this metric. And on top of that, guys, within the past 5 years, they have not been positive at all. They came close 4 years ago where they went to negative $639 million. But aside from that, guys, they have been in the red the whole entire time. 5 years ago was the worst at $3.4 billion in the negative. That really, really is awful. So as it stands, their assets cannot cover their liabilities. If things really were to go bad for them, that's really, really bad. Now, if we take a look at the average total assets, we get around $35.7 billion. Average liabilities around $37.5 billion. dollars. In doing this difference, we get negative $1.8 billion. Overall, guys, I have to give this a really low score of like 25%, maybe even 20%, just because we haven't had any single instance of positive. And on top of that, guys, there doesn't seem to be any motivation to get this in the positive either, right? They have remained around the negative $2 billion from 2 years ago to today. So it is unfortunate. I have to give it 25%. Now let's take a look at this cash flow minus the liabilities. As I said when we were analyzing the cash flow is what companies use to pay down their debts. So let's do the exact same math that we just did with the total assets and total liabilities, but with the cash minus the liabilities. Essentially, is their cash flow increasing a lot more than their liabilities is increasing? And unfortunately, as you can see right here, well, it's actually gone nowhere. Today, as of 1 year ago, they're at negative $34.4 billion. And 5 years ago, they were at negative $33 billion. So they've actually gone down. But from 5 to 3 years ago, they were increasing a little bit. And then from 3 years ago to 1 year ago, they decreased it back to negative $34 billion. So again, that's actually not really good, guys, right? Their liabilities is increasing a whole lot faster than their cash flow. And on top of that, their assets as well. So yeah, I have to give this once again a really low score. Average cash flow minus the average liabilities, we get around negative $32.5 billion. And overall, guys, I'm gonna have to give this essentially like a 20% as well. I mean, they've only been showing signs of positiveness from 5 to 3 years ago, but aside from that, guys, it is not good in the slightest. Now let's take a look at the shares outstanding. The metric that gets a lot of people, it tends to be overlooked. It's unfortunate because this is a really important metric. This one essentially tells you how much the company is diluting you as the investor, as well as if a company pays out a dividend, it essentially determines their payout ratio as well, right? Payout ratio is determined by how much their dividend payment is, as well as their shares outstanding, because the payout ratio is based off of how many shares there are out there. And if their shares are increasing, not only are you losing ownership, but they have to disperse the dividend amongst more and more people. Therefore, the chances of that dividend being cut or suspended is a lot higher. Now, when it comes to HP, wow, this is amazing. 5 years ago of 1.6 billion shares to today, guys, of 1 billion shares. Take a look at this buyback on the 5 years, 37.35%. From the previous year to the current year, guys, it is another huge number of negative 5.38%. Guys, from 1 year ago, they had 1.092 billion shares to today of 1.033 billion shares. That is amazing, guys. 5.38% in just 1 year. That is insanity. And on top of that, take a look at this. No single year, even during COVID, have they ever issued shares, which is amazing. As on top of that too, guys, that is crazy. So this actually tells me a couple of things, and that is that they're prioritizing that cash flow after that dividend is paid to essentially buy back shares, which is a good thing and a bad thing, because this is a board decision. Essentially, they could easily be like, you know what, enough buying back shares, we're done with this, let's focus on lowering these liabilities because this is not good at all. So they could easily switch from, you know, buying back shares to paying down their liabilities, paying down their debts, and these values over here could get a lot better. So that might actually give it a little bit more credibility, right? That's something that might interest a lot of people because they do have the potential to lower their liabilities, which seems to be like their only bad metrics so far, or at least their main bad metric so far. I have to give this, guys, essentially a 100%. This is a perfect looking graph. Amazing, love to see it. So yeah, I'm gonna give it a 100%. And now lastly, when it comes to the cash and equivalents, they currently hold $4.5 billion in cash and equivalents with an average of around $5.1 billion. All right, now let's take a look at all of the grades. We got the net income of 60%, free cash flow 80%, revenue 85%, total assets minus liabilities 25%, cash flow minus liabilities 20%, and shares outstanding at 100% for an overall grade, guys, of 69%. Honestly, their main issue is these liabilities. If they were to just get this down a little bit and get these into the positives, this would be so much better. But at 69%, it's essentially saying that if once they fix these liabilities, it would easily be 70% or more. Alrighty, now let's make some assumptions. Low, median, high, using of course 3 different factors: revenue growth, the predicted share buyback, and the required rate of return, which I like to keep at 10%. And before we do any assumptions, guys, take a look at this. Just with the basic 10% required rate of return, the base value is $50.03, and then adjusting for debt, it only comes down to $48.80. So just from this alone, without inputting any assumptions, guys, this is already looking like a buy. That is hilarious. That is hilarious that not even inputting any assumptions, this is already looking like a buy, which is just hilarious to me. So yeah, it is what it is. Let's actually make some assumptions now. Let's come over here to Seeking Alpha's growth tab. As you can see that the revenue growth forward is 4.38. Revenue growth year over year is 7.22. Now we did see their earnings as well, and we did see that their revenue is also beating as of May 31st, right? So you know what, let's actually make some assumptions in accordance to that revenue beat. So I would say for the low assumption, let's say at around like 5%. For the median assumption, let's say 7%. And for the highest assumption, let's say around 9%. Now, for the predicted share buyback, guys, okay, they have been buying back a whole lot of shares, right? 37.35% on the 5-year and 5.38. Will they continue to do this in the future? Probably not. That's a massive amount of share buybacks. I'm actually willing to believe that they may even just stop buying back shares, honestly, because that is insanity. They really don't need to be buying back any more shares. At this point, there's not going to be any shares for the rest of us. So I'm actually going to say for the low assumption that they're not going to buy any more shares back. I'm going to say 0%. For the median assumption, let us say within the next 4 years that they do around 5%. And for the highest assumption, let's bring this up to like around like 8% or so. I would say like 10% just to keep everything, you know, in increments of 5. But let's just put 8 because I want to see where this thing lands. So as you can see, now we do have some target share prices for the low assumption. Assuming a 0% share buyback, this is $59.66. Median assumption is $67.20, and the highest assumption is $74.14. Adjusting for debt, this does come down by around like $1 or so to $58.43 for the low assumption, $65.90 for the median assumption, and $72.80 for the highest assumption. Adding a margin of safety of 5, 10, and 15%, this puts me between the ranges of $49.66 to $55.51 for the low assumption, $56 to $62.61 for the median assumption, and $61.88 to $69.16 for the highest assumption. Guys, in every single scenario, it is a buy. The current share price is $31.39. Yeah, there you go. In every single scenario, it is a buy. That is insane. This is crazy. So let's actually say that when Tuesday comes along, their revenue growth is just awful, right? They're going to be, I don't know, -2% when it comes to the revenue growth. Let's say 0%, and let's just say 2%, right? Let's just say this. Even then, at the lowest one, which is the highest margin of safety, of 15% for the low assumption, it is still a buy. This puts me between the ranges of $38.51 to $43.04. This is insane, guys. This is absolutely crazy. So I don't know. As it stands, Hewlett Packard, you know, HP, it's looking like a good company, man. Like here's also the thing too. For all it's worth, Warren Buffett loves this company, absolutely adores this company, and here's the reason why. It is at a great price. Their fundamentals aren't, you know, amazing, but they do have a lot of possibility in the future to switch those share buybacks to actually pay down their liabilities as well. So overall, it's not looking too shabby, guys. But again, as I always say in every single video, please do not take my word for it. And by the way, don't even take Warren Buffett's word for it either, right? I want you guys to have these calculators. I have this one, the book value one, the reevaluation one, and a dividend tracking sheet for all of you guys to have, because I believe that, you know, everybody should make their own assumptions. Every investment is the present value of all future cash flow, and this is not financial advice. Please have these calculators and see what you get for a target share price. You guys may want a lowered required rate of return, or you may think that they'll actually continue to buy back shares or whatever, right? please have these calculators, see their metrics, and give them your own grades, because at the end of the day, again, not financial advice, and every investment is the present value of all future cash flow. All I'm asking for in return, guys, for these calculators, daily content, is just please help me grow my channel. We are more than 900 subscribers in right now. As if I'm recording this, it is 927. Guys, if we could make it to 1,000 by the end of September, that would be insane. And I also have a pretty awesome video planned out for the 1,000 subscriber milestone. So if you guys want to see that, please make sure you hit the like, hit the subscribe, and just help me grow. That's really all I'm asking. I'm not asking for anybody to subscribe to like my Patreon or anything like that to give me money. No, all I'm asking for is just please help me grow my channel, help me grow this community. That's about it. Now let's actually analyze these dividends, because last time I did this, I did not have this. So let's actually see how much you would get if you were to put in 1 month's income of $5,725 into this company, paying $1 in annual dividends per share. And while doing so, guys, this would get you 182.39 shares. And as a current annual dividends per share, well, it'll be the same because it's $1 per share. So you would get an annual dividends $182.39, quarterly dividends of $45.60, and a monthly dividend of $15.20. So not too shabby. It's not over 200 as I would like it, but guys, they are very, very, very good buy right now in accordance to my assumptions. So please do not follow them, but they do seem to be like a very, very good buy. And on top of this dividend, you're also going to get a massive share appreciation as well. So take that with a grain of salt as it will. If you guys like this, then by all means invest in it. But if not, then, you know, of course, do your own research. All in all, guys, when it comes to HPQ, you know what? I gotta say, I like this company. I really do. I understand why Warren Buffett likes it so much. I also realized something as well. When it comes to their share buybacks, guys, recently the Inflation Act passed, and it actually included a 1% tax for the share buybacks for companies. So this would actually disincentivize companies to buy back shares and probably instead increase that dividend. So for all it's worth, maybe they won't be buying back any more shares. Maybe my 0% predicted share buyback might actually be more accurate than not, right? So take that as it may. Things may change. They may not do that, right? But don't be surprised if they do end up increasing this dividend in the future because of that reason. All in all, as it stands, guys, if they stop buying back shares, they increase that dividend a little bit, they focus on lowering their debts, guys, you might be sitting really, really pretty when it comes to this company. I'm not gonna lie. But again, please do your own due diligence, have these calculators, and make your own assumptions. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help out with the algorithm on YouTube. As I said, you guys can follow me on my YouTube sites, link in the description below. So with that said, peace out, and be on the lookout for the next stock analysis video.